I'm going to start this panel by just reading a stat from last year in the St. Louis, or last month in the St. Louis Business Journal. So the St. Louis Archangels, which is an angel investment group, invested $11 million last year, making them one of the most active angel groups in the country, according to the Halo report. Lots of people don't know that, but there are really, really robust investment groups in St. Louis, the Archangels being one of them, and there was other ones represented on our earlier panels today. So I want to welcome you to this panel. This is panel C, starting at 4:30. It's Plan for Funding, M&A, which is mergers and acquisitions, and exits, which is the same thing as mergers and acquisitions, from the beginning, when you have an idea. So I want to thank you all for coming out for this panel, and I want to thank our sponsors for allowing everyone to participate today. So I'm going to have the panelists introduce themselves, and then I have a couple of announcements, and then I'll let our moderator, Andy, take over for the panel. So go ahead, Andy, if you can go first.
Yeah, good evening, everybody. Thanks for coming. My name's Andy Hoy, and I'm a senior partner at the Polzinelli Law Firm downtown. I do venture capital work, mostly in life science companies.
I'm Bob Calcaterra. I actually was in industry for about 25 years, mostly doing M&A work as well as diversification work. I came back here in 1999 to start my third incubator, which was the Nidus Center, which you all may remember was Monsanto funded. I'm a founder of the Archangels, and also right now I'm involved in two organizations, Startup Partners International, where I actually work with 3 federal agencies helping companies with their commercialization plan. And finally, I have a number of partners who, many of them are in different panels today, called the Exeter Group, where we actually populate in partnership with entrepreneurs managing the company and starting the company. We've started 2 companies and are in the process of starting 3 more.
I'm Ryan Rakestraw. I'm with Monsanto Growth Ventures, which is Monsanto's corporate venture capital group. The group has been around about 5 years at this point in time, looking to partner with and invest in exciting entrepreneurs that have the next new technology, innovation, or business model that can accelerate profitability or sustainability in global agriculture. I've been with Monsanto Growth Ventures a little over 2 years. Before that, I spent a little bit of time with Yield Lab, which is an accelerator program based here in St. Louis that also invests in food and agriculture related startups. And before that, I was with Cultivation Capital, a venture firm also based here in St. Louis, investing locally. So I've seen a few different perspectives from the St. Louis ecosystem over the past 6-7 years. Excited about the momentum that's happening, and especially about the activity that's occurring here in the agriculture innovation space.
Brian?
Hi, I'm Brian Hopcraft. I'm Managing Director of Lewis & Clark Ventures. We're a local venture fund that is really interested in kind of 3 broad categories. So anything that's kind of tech-enabled or software, whether that's enterprise or software as a service related. We're also very interested in digital healthcare and agriculture as well. In fact, we've co-invested with 1, maybe soon to be 2 companies with Ryan and Monsanto. So very excited with the partnership we have here. We look to fund companies that typically have revenue of at least about $1 million. So we are A stage and B stage, and I'll explain some of that, what that means later. But we look for companies that have traction and are really looking to accelerate that growth. My background, I spent most of my career in industry, as in the software industry, as an entrepreneur or as an executive at various size companies. So very excited to be on the venture side here and to share my perspectives from both sides. Thanks.
I'm Ashley Edwards. I'm an attorney at Hush Blackwell. We work mostly out of Clayton, but I'm also part of the team that helps run our office in the 4240 building at Cortex. I am a corporate attorney. I do primarily mergers and acquisitions, M&A, but I also work with a lot of companies, including a lot of startups, on financing, commercial contracts, corporate governance. I started my legal career out in Southern California, but being born and raised in St. Louis, of course, I came back. And it makes me really excited to see how the startup community has really taken off in St. Louis.
Thank you very much, panelists. So again, I encourage everyone to fill out the surveys about our panel. We really do read the feedback and appreciate it. And if you're not a member of the Missouri Venture Forum, you can check the box and say you're interested in joining for a free chance for a free membership at the end of the event today. So money is the fuel of every business. We all know that. And finding it is a long-term process. So if you do it right, you succeed. Do it wrong, and you will perish. The panel is really going to look at funding, but it's also going to look at things to think about when you're starting your business, like, am I starting it to sell it, or am I starting it to build it for my kids and grandkids? And those two different paths you have to make different choices. And so it's things like that that this panel is going to evaluate. So I'm going to hand it off to Andy. Andy, I'll let you drive this panel. Thank you very much.
Yeah, thanks. So actually, just as a segue from that, in reality what we're going to talk about are companies which are high growth, usually technology based, but entrepreneurial based, where there's going to be an exit at the end of the road, where companies are not what we call lifestyle companies. Lifestyle companies are the gift shops and the restaurants and things like that, where you are just planning to keep working and working and working. We're talking about situations where it's going to be a high growth business and so on. So what we thought we'd do first is just kind of give you a few ideas, overall ideas, and without getting into the specificity of our panel thing about how to build a high quality business, okay? And I'll start with, I've got just two that I'm going to toss out, and we'll just kind of run down the panel. But two are this. One is, because money is so important and money is so tough to get for these kinds of business, the filter that I encourage my clients to use is to make all their decisions, whether they're important or unimportant, seemingly important or unimportant, based upon will it help me raise money? Will it help me raise money? And from my perspective, if that's all you remember coming out of this thing today, you've learned enough. Because if you start looking at your decisions from that perspective, what's the name of the company? Where is it, LLC or corporation? Where am I incorporated? Who's on my team? All that sort of stuff. Will it help me raise money? The second piece is that, and I see this particularly in the life sciences, is what I call speed. It's a competitive environment out there, and the companies that just delay and delay and delay take forever. You lose whatever momentum you have. You lose whatever momentum you can get from the other people who are helping you, and it makes it that much tougher. And obviously, you don't want to go forward and make a lot of hasty, unwise, unconsidered decisions, but you also don't want to go so slowly that nothing ever happens. So I'm going to rotate down to Bob.
And what's your question, Andy?
So my question to Bob is, okay, so talk about when you're putting together a team, a good company team, who should be on the team? What sorts of people should you talk about? I mean, you talk about you're this Exeter group and you put together a management team, but whether it's your team or somebody else's team, what sort of things do you look for?
Well, as I said in my introduction, the Exeter Group is about 10 partners, and we cross over everything from marketing to people who have financial background, people who have started companies and exited, and also people who have experience at putting together partnerships and working in certain discipline. So what we try to do is when we work with an entrepreneur is in fact address what you had said, Annie, which is you got to you got to start the company, and you've got to try to move forward quickly, because if you're slow and you're methodical, you may lose the opportunity. Or time. In my opinion, time is more important than dollars. And so we will actually populate the company with a CEO, with a marketing person, with a chief financial person, and in some cases, the entrepreneur typically is technical, but we will bring in other expertise from other locations to address other parts of the technology.
Brian, talk a little, this again, we're talking in general terms about how to put together a strong company, and talk the sort of things that Monsanto might be interested in terms of market opportunities. Are you looking for big items, little items, platforms, those sorts of things?
Yeah. I'll come at that from my Monsanto perspective, then I'll also maybe talk generally as a venture capitalist. From Monsanto Growth Ventures perspective, we're looking to invest in companies first and foremost that have technologies related to agriculture. So, and I would say generally, that's not just a Monsanto thing, but certainly there's a Lewis and Clark, or any given investor, tends to have industry preferences, given the team's background, where they're located, the types of deals that they've invested in previously. So our team focuses on agriculture, but that doesn't necessarily have to be a new corn plant, although we certainly look at those. It can be really any type of technology that we feel has the belief that can facilitate, again, this idea of productivity or sustainability in agriculture. So we tend to look at things in healthcare. We tend to look at things in information technology, in automation, robotics, chemistry discovery platforms. Really, the technology space is very broad, but that we view it through the lens of agriculture. I'd say that VCs are more interested in markets where there's a growth, high growth opportunity, markets that are nascent, where there's an underserved market, and certainly a market that at least people perceive is going to be growing, and that changes, over time. Maybe just the example is kind of some of the solar or green energy that was there was a phase of that in the early 2000s, and that was a major area of venture capital investment. Which isn't although there's still companies pursuing that, there's still really exciting technologies. From a venture capital standpoint, that's an area that's not as trending as highly as something that would more be kind of in the artificial intelligence, machine learning type buzzword space. So I come at that from general VC. There certainly are clusters of technologies or industries or markets that VCs find more interesting, and that changes over time.
Thanks. Brian, one of the things that I'll sometimes look at, and you can talk about this, is that sort of the impact of how much money a company needs to raise, how many raises they need to make, and so on. I mean, you mentioned software as a service and some of these other things, but how does that factor in? If someone came to you, for example, and said, we need to start off in raising $25 million, I mean, how would that affect your feelings about them?
Yeah, that's a great question. And yeah, I think if they came to us looking for $25 million, we might we might pause and look at them and kind of say, explain that one to us. But yeah, I think as you think about venture funding or just looking for capital, I think a lot of great points have been made. You really, depending on where you are in your company, you may approach different funding sources. And I think it's helpful to think of that funding kind of continuum of you're unlikely to raise just a pool of money up front and never need capital again. There are those businesses, those are great ones to have, and that's not the common thing at all. So you should be thinking about kind of how much money do I need to get to the kind of the next proof point in my company or product's evolution. So when we see a company that comes to us, we absolutely look at the team and market and kind of the segment and other things that have been mentioned. Those are all very important. And part of that consideration on the capital side is, how much money do you need? And we like a very specific answer, although it can absolutely be a range. So when somebody comes to us and says, I'm looking for $5 million, and we say, great, that's in the amount of money that our fund invests, or that we'll invest as part of a syndicate with maybe a group such as Ryan's. But we want to know, how did you come up with that dollar amount? And why not $4 million? Why is it 5? And really, what are you going to do with that capital? So who are you going to hire, and how are you going to go to market with that? And then we're thinking again in terms of that stages. What will that capital get your company to? What will your company look like at that next stage of evolution? Because then you'll be going for another, most likely, amount of capital to get you kind of to the next phase. So oftentimes if you're an early stage company, that first outside money is really just going to help you get a product to market and see if customers want to buy it. That's probably an angel investment or something like that. The next phase is you've got somebody to buy it. You probably approach a venture fund. You need more money now to see if you can get more customers to do it. So think in terms of that progression and kind of steps in your hierarchy of kind of evolution of your company, I think is very important.
Thanks. Ashley, Ashley mentioned she does a lot of mergers and acquisitions work, and so at that time, when the companies are being sold at the end of the line, it's always one of the things is to kind of go back through the documentation and make sure everything is there, because so the buyers know what they're getting and companies can sell. So could you talk a little bit about how that process and even from the beginning, how that all fits together?
So Andy makes a great point, which is in the M&A process in particular, I as a lawyer get to look at your company when you're selling your company, and I get to look at it from a sort of emotionless standpoint, since I'm not the one who has money involved here. And I get to really kind of look at the big picture. I get to look at your IP. I get to look at your real property, your personal property. I get to look at how you guys make your money. I get to look at how you lose some of your money. I get to look at your capital structure. I get to look at the big picture of how your company is put together, and so from an outside perspective. So I think it's kind of interesting. And so one of my favorite quotes I've ever heard about growth, particularly related to startups, is you can grow fat or you can grow strong. And growth for growth's sake is not always good. And so sometimes I've seen companies where they just sort of add for the sake of adding. They almost grow for the sake of growing in ways that may not necessarily benefit them. And the way that this really sort of comes back to bite people in the end is when you're preparing for an exit, or if you're preparing for fundraising, because really fundraising, getting ready for fundraising in a lot of ways is very similar to getting ready for an M&A process, which is you need to have all of your ducks in a row. And there are certainly people like me who can help you with that, but one of the key things that I have found is that will set your company apart and make the whole process way simpler is to have a CFO and to have your kind of financial team also have their ducks in a row. I think that what makes you an attractive target is going to be really all the same types of things that help you guys operate on a day-to-day basis for every day before that. So if your CFO understands exactly how your accounting works, all the, whether or not you guys are GAAP compliant, or if you have any variances in GAAP, if you have various kinds of contracts, if you have outstanding warrants that everybody kind of forgot about, if you promise somebody a bonus, some great employee, you promise somebody a bonus upon an exit or upon the next round of fundraising. If you just kind of be like, oh, I forgot about that, and just sort of think about it towards the end, you're going to have a much tougher time. But if you really kind of have all of your ducks in a row, and you have grown strong rather than just grown fat, you're going to be in a much better position.
I know it sounds simple, but you would be surprised how many clients of mine don't have all their stuff organized. It's always a continual struggle.
Well, that's not because they're clients of yours.
That's not, I don't, in spite of the fact, yeah. Hey, so we're talking about raising money, and usually the first thing that people think about is, what's the value of my company? And so I'm going to get some feedback from a bunch of the people on the panel here. But so Bob, when you were doing stuff for the Archangels and some group came in and said, hey, we'd like to pitch the Archangels and we want to raise $500,000 of angel money, and we think we've got a pre-money valuation, pre-money mean before the new investment comes in, of $10 million. And I mean, where do you come up with a number when you say, I think that may be a little bit high? But how do you figure out that early stage, that angel investor? How do you figure out what the right number is for them to do that? Recognizing it's sort of a negotiation, right? But also, how do you get with even in the ballpark?
Well, I guess I'd start by saying it depends what the stage of the company is, and of course, we tend to see companies that are pretty early stage. But if it's a company that's raising a B round, they've already had they've raised $5 or $10 million. They're trying to raise a substantially larger amount, and they've got a significant amount of data, and they're ready to start filing papers with an IND with the FDA or something. Then it's a different proposition, because you can look at, okay, 4 or 5 years from now, the company's going to exit. If I put this amount of money in, what are they going to exit at? Can I calculate back what the company's worth now? That's the standard venture capital approach. But most cases, we see companies that are very early development stage, and it's not unusual that we see people that said, I'm worth $10 million. And it's more of a reasonableness of whether or not it sounds like this is an opportunity that could generate hundreds of million dollars, but it's just ludicrous to, at the very early stage within the first year or two, and when you just have an idea and you're not that far along, to ask for that kind of valuation. And so, not that you pick it out of the air, but it has to be a very reasonable amount. The other thing I might say is there's this belief by a number of people that we typically see that they've raised maybe $10 million in money from grants from a federal agency. And they have this belief that since they've raised all that money through grants, that in fact that applies to the value of the company. The science side of it is not what is important. The important piece is how far along have you moved the business? And is the business opportunity laid out properly? Is there really a business opportunity here, not just a bunch of science data that you've built through grants? So grants don't equate to valuation.
Yeah. Ryan, how about when you guys get something from Monsanto? What do you look at to figure out if this is within the ballpark?
On the valuation?
Yeah.
Yeah, I mean, there's maybe a few different cuts with that. I mean, the first, we're not in the business. We want to make money on our investments, but at the same point in time, we want the entrepreneurs, founder, management team. They're in this to create, enterprise value in the company, to create something big. So we're always cognizant of doing something that's fair, something that the management team is still highly incentivized to build a big business. So that's one angle. I think the point about that it's a negotiation, I think is also relevant. This is supply and demand. If you've got something that's really interesting that a lot of investors want to be a part of, that can dramatically swing what the perceived value of what the company is worth is. And the opposite is also true. If you don't have a whole lot of opportunity with a variety of different investors, maybe there ends up being a number that you're not quite as happy with. I think for you as in the audience as entrepreneurs, something to think about is just to have different plans associated with raising money. And in fact, maybe if you don't get the valuation that you want, maybe you should have a plan of, well, what's it look like to delay raising capital for a year. Maybe we don't make that hire or expand into a second market, and what are the impacts associated with the business. I think you also think about the opposite scenario. Maybe if we ended up getting a lot of investor interest, maybe instead of raising $2 million, we raise $4 million. And what's the opportunity there? We can accelerate hiring, we can launch in another market, we can develop new tech, that type of thing. So I think the startups are flexible. The business can change. You can accelerate growth. You can slow down growth based off of some of the cash flows that you have. And if you don't have that, you should have a plan around some of the risks associated with that.
Brian, you want to add any more? And in particular, can you talk about, Bob and Ryan mentioned exits and alternatives. And can you talk about where do you get that information, if you get it?
Yeah, excuse me, valuation and the value of a company is always really interesting, and I can think of about a tremendous amount of great examples for that. But maybe I'll start though. When I was an entrepreneur a number of years ago, we had a product and we built kind of a minimum viable product, and we were going to go out to raise capital from other than friends and family, and we kind of thought, well, what do we think the valuation of the company should be? How much of the company are we selling for what amount? And we had a lot of debate internally, and I think it was just a small group of us at the time, and we made the decision that probably the highest amount we can look somebody in the eye, seriously ask for was kind of the answer. So it was less science and it was more art, and in that case, we didn't have any revenue or very little, and that worked for us. We asked for something that was reasonable, it worked. So that's if you're on the kind of very early stage side of things. What we look at now is we try to get a sense of when a company comes to us. Oftentimes, or most of the time, they've had a prior funding round from somebody, so from friends and family or from an earlier stage venture fund. And so we get a sense from them of, okay, last time we raised $1 million at a $5 million valuation, and that was 2 years ago. And so then we kind of have something to anchor the conversation, or at least we know what the history says. But what we try to do is, as Bob mentioned, kind of figure out what do we think the return's going to be based on the rate we need to accomplish as a venture fund, and you basically estimate back to what you think the value now needs to be to get that return, should things go the way you think they're going to go. So those are all things that factor into it. And how we look at that is we look at the market and we try to get an understanding of what other companies are similar, what was their most recent valuation, especially if they're companies that we've seen. So we see a lot of companies that we don't end up investing in, and we have a pretty good sense of how much revenue they had or how much traction, that kind of thing, what they were looking for from a valuation standpoint. So we have a sense of the market, but we also try to find comparable companies in which to compare them to is part of it as well. I would say some things to think about is you never want to be too high in your valuation for all the reasons that were mentioned, but it really, even if you were to get that valuation, your expectations are pretty high. So you want, I think, to have something reasonable, as I think Bob mentioned, and that's really going to bode well for your kind of future funding needs and kind of expectations for whatever stage company you're in.
So, listening to everybody and thinking about it, Andy, normally what drives a person in wanting a high valuation, of course, is they don't want to see dilution. And so I always say to people, it's more important to think about, if I take a certain amount of money now, where will that take me, and will that in fact add value to the company? So the most successful companies I've ever seen and worked with, they might raise $500,000 that take the company to a certain point, and in fact they've accomplished a tremendous amount. They go out and raise $1 million, and they accomplish a whole bunch of goals that they've set, and they move it along stage by stage. And each stage, they've succeeded in hitting milestones that in fact add substantial value to the company. And so they stair-step this thing, and that's the most efficient way to reduce the amount of dilution. And so as Ryan said, you don't always have to raise $10 million day one. Maybe you want to raise $500,000 and then raise another $1.5 million a year later.
Because as the value goes up, the amount of money the
Right.
amount of ownership that
Doesn't
the investor-
always mean the investor's going to give you that valuation,
right.
but at least that's the thought process.
Yeah. So let's take a just a brief segue here. Raising money is subject to lots of state and federal laws, and Ashley's going to give us the 2-minute synopsis of that. Just things to think about, okay?
So everyone's been waiting for this. The absolute sort of biggest caveat is securities law is not exactly a DIY friendly part of the law, so please consult an attorney. I could probably wrap it up there. But I think that while we're talking about the business points quite a bit, it is important to focus a little bit on the legal aspects, because ultimately when you're fundraising, you're selling the equity of your company, and that equity are securities. And you are therefore subject to federal securities laws. You're also subject to state securities laws, but we'll mostly ignore those. So federal securities laws are dictated mostly by the SEC, the Securities and Exchange Commission. And I think it's helpful whenever I've kind of taught this stuff to other people, it's really helpful, I think, to focus on what their goals are, because I think it helps sort of underlie why they do certain things that they do. And so the goal of the SEC is to protect investors from the proverbial snake oil salesmen and Nigerian princes via email who say, you know, hey, invest this amount of money with me, this small amount, and you're going to get, you know, 10x in return. It's going to be great. Just give me your money. And their goal is to kind of help protect investors from that type of thing. And particularly, these securities laws were from the, you know, they were written mostly in the early 30s. So, or they started off really in the early 30s. And so I think that once you think about that as sort of the underlying goal of the SEC, it helps explain why they do a lot of the things they do. And so the mechanism by which they sort of accomplish that protection of the investor is by really regulating almost every aspect of the sale and distribution of securities. So that's going to be when you can offer securities to people, what exactly you can offer, how much you can offer, who you can offer it to, how many people you can offer it to. Almost everything about securities is subject to those securities laws. And so there are, I'm probably a little bit over 2 minutes now, but there are plenty of ways. It's not that there are only barriers to fundraising. There are some very, very common, what are called exemptions to registration that are available to people who are fundraising. And again, your attorney in your particular situation can help you navigate those. But it's important just to remember, don't try this at home.
Okay, thank you. So that's very brief, but so what we're going to do now is go through some of the stages of fundraising, or some of the stages of a company organization as it goes forward, and each of us are going to talk about different stages. My stage is the founders round, so it's pretty simple because usually there's not a lot of money coming into, but I'll just give you my real short synopsis of how I do that. I start off with 1 million shares in my pool of stock. And I say to the founders, here's 1 million shares. If there is one of you, you get 1 million shares, or 900,000 shares, and we put 100,000 in for the option pool. If there are 3 of you, then maybe you get 300,000 and another 100,000 for the option pool. If that's you're all equal. But when I talk to founders who come into the office, I say, you figure out how you want to divvy it up and who's going to work how hard, who's doing what, that sort of thing. The second thing is that at that really early at founders level, there's something called an 83B election. You can file with regard to founders whose stock or early stage people's stock is subject to vesting. And vesting is great because there are people who found companies and then after a while their interest wanes, or maybe they get the opportunity to move to Philadelphia or who knows what. But vesting really helps because it encourages, it's a mechanism that allows people to say, hey, you've left, thanks for what you've all done, but now we're going to get back some of your stock or cancel your option, that sort of thing. So founders round, roughly 1 million, vesting if you can, and 83B election for certain, if there's vesting. Bob was going to talk about friends and family and angels and some of the things you've learned from that at that stage.
Well, of course, the first people to go to if you have family members who have enough money that they can invest in the company is to go to them, because obviously, and it should say friends, family, and fools. I noticed that's been politically taken out of here. But they're the people that are going to believe in you. They're going to be very patient. They're going to be willing to put some money behind you because they want to support you for emotional reasons. Not that angels aren't emotional. A lot of times you'll find angels will invest, unfortunately, because they are emotional about whatever it is you're doing. Might be a disease that's common in their family or that type of thing. But nowadays, most angel investors, especially groups like my Archangels, are very sophisticated, and we in fact have people that do due diligence for us. We expect to see due diligence, for example, from the Archangels, from the Biogenerator or other angel groups that might be investing from other communities. And so we're not necessarily completely blind and not understanding the particular market or opportunity. So we will do due diligence, and I would say that over the 12 years that I've been associated with the Archangels, we probably only invest in about 10 to 15% of the companies that we listen to.
Bob had an angel round, friends and family angel round. How big are those? How much can people expect to raise at that stage?
I can give you good examples of companies that have started with $200,000-300,000 and progressed enough then to raise the next round of maybe $600,000-700,000. I'm on the board of a company that I'm a co-founder of that now has raised $4.5 million from the Archangels, but it started at around $300,000 to $400,000, and it's like in its fifth round.
Okay. Brian, how about on the venture capital side? What do you say to folks thinking about venture capital?
Yeah, I think it's a matter of how much capital do you need for what you're trying to accomplish, a little bit of what we were talking about earlier. So again, by the time that a company is coming in to talk to Lewis and Clark, or even Ryan can talk about this as well, you've probably had friends and family and you've gone to the angel networks. Maybe you've bootstrapped the business, meaning you've funded it by customers and maybe what you've put into it, or you kind of went without salary for a while as you got to customer revenue. But that's more of an anomaly. So the companies that come to us have some prior funding and are now looking for that next level. Typically, what we look for are companies that the capital where we invest will be mainly going to sales and marketing. So the product market fit is established, meaning you've got customers, multiple customers, not just one or two. The price points for your product and the pain that it solves are all been solved and kind of demonstrated. And really, you want a lot more capital to help grow your business, hopefully a lot more rapidly than you've been able to. So it's very kind of stage dependent as to what the characteristics we look for and what our expectations of a company that's coming in are.
Brian, your local firm, should folks go out of town looking for venture, or does it make more sense to come locally, or both, or all of the above?
I think you certainly want to start locally. One of the things about St. Louis is there are now funds at kind of every stage. There's angel, seed stage, and these are all terms that really kind of correlate to the amount of dollars that will be invested roughly. Kind of Series A, Series B. Those are just the progressions and how much money you're looking for. So it's absolutely better locally because I think you'll have so many more connection points to that fund. I think we look at 100 plus companies to invest in one. So if you think about that from the other side of it, you have to find a lot of potential funders, and that has to be your expectation to find the one that really fits. And so it's also not only the capital that you're looking for and where you're going to raise that, but I think every funder has a different investment philosophy, different types of partnering. I think you want to be very comfortable with the people that you're going to be working with too. So it's not just the capital, but it's the people that you're going to work with. And are these people that I want to work with and help fund and grow my company? So those would be some thoughts I would share.
I would just add that it's, these venture capital early stage investments, a lot of this is built on trust, and generally it's easier to establish trust when you can go meet the people, next door or locally. And it doesn't necessarily have to be that way, but that's something to keep in mind is, you can look at business plans, you can look at intellectual property, but at this early stage, and even at the earliest stage, this is even more important, it's really about establishing trust with the investors. And I would say that also goes the other way. Giving up, don't give a portion of your company up to anybody. There needs to be a sense of trust, that goes the other way from the entrepreneur back to the investor as well.
Ryan?
I have a little different perspective, Andy, in that some of the companies we've started, for example, one's a medical device, and we've found that going to Minneapolis with some introductions from people we know is much easier because, of course, Minneapolis is a center of medical devices. And so we found it easier to actually start there than here because people are less familiar with medical devices. Also, with that same company, the principal investigators are in Illinois and in Washington, D.C., and are extremely well known there. And they know a lot of people there that are very willing to invest because of their knowledge of their capabilities and their success. So we've found that there are some cases, not that I disagree with what the guy said, I agree 100% with what they've said, but there are some cases where it may make sense to go outside of the region, even though the company's here in St. Louis, located, headquartered here.
I would say, if you're seeking capital outside of the region, keep that in mind as how are you going to establish a relationship with investment group outside of the region? Is that a warm introduction? Is it a previous relationship? Is it some credibility by academic background or industry expertise? There needs to be something.
There has to be a reason.
Yeah, a reason.
Ryan, do you know, and this is unfair because we didn't talk about this before, but do you have a sense as to, or maybe anybody, as the sense of the amount of corporate investment versus venture capital fund investment?
Yeah, so I think about the universe of venture capital dollars invested in the U.S. as being a $77 billion industry. Fluctuates depending on stock market or all these different factors. But of that, and a few thousand deals in that. So on a deal basis, about 20% of deals contain some corporate investor. The dollar amount is a little lower. About $10 billion of corporate venture capital is invested on an annual basis. So it's actually quite a substantial amount of capital invested from corporate venture capital groups. And then I would even say locally, between Ascension Healthcare, Boeing, MasterCard, Meritz, Emerson, Amarin, Express Scripts, all Purina, all looking to kind of participate at the investment level with startup companies in the area, whether that's through a group like Lewis and Clark or Capital Innovators or directly.
Yeah. Is it on the corporate side? Is it better to go in from the venture arm, or is from the people at the lab and the research relationships, or both?
So if a startup company was to approach Monsanto, if it was regards to a customer relationship or partnership, you would work with folks that do that. And if it was about investing, our cash into the company, you would work with our team. Of course, since we know each other, any point of entry works, and we'll make sure that you get to the right place. But there definitely are, different roles within the organization that are, managing different relationships.
The takeaway being that as the company builds and goes forward, it's important to begin to establish that dialogue, because that could be a significant amount of money on a later round, earlier round, exit, whenever. Yeah. So, Ashley, you've heard all this talk about the various funding levels and so on, and from the exit perspective, what can you add to this conversation.
So when people talk about exits, it's kind of important to remember exactly what that is. And just with some of the startups that I've worked with occasionally, they're not 100% sure what that means. And the exit is not necessarily how you as the founder of a company exit. It's oftentimes used to refer to how are your investors going to make money. Because as a business, you know, they want to put in a certain amount of money, and everybody kind of focuses on that part. That's the fundraising part. But the exit strategy is really sort of on the back end. What are they getting out of it? How are they eventually going to make their money? And so oftentimes you can just generate enough money to, you know, to make everybody happy, and that's possible. But typically when people talk about exits, it's really kind of a code word for M&A, which makes me happy because this is what I do. And so I think that for M&A, I'm just going to mostly echo kind of what I said earlier, which is, again, if you have your ducks in a row, you are going to be in a much better position. And particularly when it comes to your cap table, if you've done this whole process from all the way from kind of, you know, your founders round, your seed round, Series A, Series B, if you've done all of that with the due diligence that I imagine your investors are going to want you to have done it with, and you really have kept track of any sort of extraneous stock options or warrants or just the errant, yeah, don't worry about it. When we sell, you'll be taken care of. As long as you have all of that kind of taken care of and locked down, all those ducks in a row, you're going to be in a really good position to be ready when that opportunity comes.
So we're going to open for questions in just a minute. I got two more points I wanted to make here on the list here. Number one is on a technology type company, there are these federal grants, SBIR grants that provide a lot of different funding for a lot of companies. The most successful companies I've seen are the ones that raise about $1 of grant for $1 of investment. It moves the company along, it's non-dilutive funding, it's a real plus, but it takes a while for a company, for that process to work. But it's important that part of the team that's built up for that company watch for those grants, look for the opportunities, look for the seminars that talk about that, do all the stuff that's necessary to raise that money. Sometimes it's not just the SBIR grants, but different kind of grants from foundations, corporate partnering deals early on, all those kinds of non-dilutive. The other thing I think, just from a general overview point, the thing to think about, what we're all saying up here is that from an investor's perspective, they're looking for an investment opportunity, not a science project. And so they're looking for a thing that says, I can invest in this, I want to invest whether it's for financial return or feeling good about things, or I think it's the right thing for the world or St. Louis or whatever. They're looking for an opportunity to invest. And so when you go together and you work on whether you're pitching to your next door neighbor or Brian or Ryan or Bob, you want to be in a position where you can say, this is an investment opportunity for you. And then kind of go through all the stuff we've talked about, the team, coming up with grants and alternatives, what Ashley's talking about is being organized, the intellectual property, all those things that come together. So now we're ready for some questions. Okay.
Two questions, one for Ryan. Is Monsanto interested in beyond agriculture? You just mentioned technology. Other than agriculture, they are interested in?
Yeah, the interest, everything has to have an application in agriculture, but the company's primary business model doesn't have to be focused on agriculture. So you could be developing a therapeutic focused on the human therapeutic, but you've got platform technology that we think could be applicable for crop protection chemistry. So that would be an example. Similarly, in things like image analysis, so this, you using an unmanned aerial vehicle to collect images and doing the analysis on that, and that could be images of a construction site, or it could be images of a cornfield, and maybe the technology is mutually applicable.
Is that technology for plant diseases, which we think that it can be applicable to human diseases? Would that be of any interest?
This is a pitch session now.
Or let's sidebar it
Yeah.
and
Yeah.
discuss it after the panel.
Yeah. Well, but Ryan didn't mention, but Monsanto bought Climate Corp for $1 billion, right?
Yeah.
So,
Yep.
huge acquisition of a company out in California that did climate mapping and things like that. So that's, that's not what you might first think of as agriculture.
So, my question to the panel, we have a technology platform or something stability. So the exit only you sell the company or the IPO is more interesting to the investor.
Yeah, my perspective, if I understand your question, is, do we look for IPO or other exits? And I think the reality is everybody would love it if you IPO'd, but only maybe 2% of the companies that ever get venture investment IPO. So most of the time, 96, 98% of the time, when there is an exit, maybe I'll put it that way, it's someone's acquiring you or there's some other M&A versus an IPO. So if we look through when we are evaluating the opportunities, we always think, yeah, could this be an IPO-able company? Maybe, but if it's a good company, people are going to come to you and offer something for the company. So it doesn't have to be an IPO as your goal, if that was really your question.
From fund point view, then maybe maybe not interesting to sell, but more interesting in IPO. If that the founder and the investor has kind of conflict or not, it will be see the common goal eventually.
Yeah.
I don't think we would have any disagreement with you if your mentality and business plan was to create a business that was capable of doing an IPO. And whether or not that ended up truly IPOing or being an acquisition, that's not an issue. I think the point is that you have to have the mindset, team, business model to be able to provide some source of return on capital back on the investment. And growing a company that doesn't have any intellectual property or only gets to $3 million in sales, isn't what we're, that's not the venture capital business.
Other questions? In the back?
Yeah, at these different stages of investments and nature of the venture, what is the expectation of the company for your return multiple
The various stages,
yeah.
what's the expected return at the various stages?
I mean, I'll cite some of the numbers. So, if you look at venture capital funds, so if I'm Washington University in St. Louis and I've got a $13.5 billion endowment and I'm making investments in venture capital funds, what is the level of return that I would like to see? So that typically varies kind of between a 20% and 30% rate of return. So that, and these are typically over the course of 10 years. So venture capital funds are deploying money over a 10-year period. So I think a 26% IRR over a 10-year period is a 10 times multiple. And that's a number that you'll oft-hear quoted is what venture capitalists are looking for is kind of 10 times their money, which sounds like a ridiculous amount, but from their perspective, a number of their portfolio companies aren't going to be successful, and they're in the high risk business.
And for the angel group, I will say that their expectations are not much different. They really sophisticated angel groups understand that they're going to lose 80 to 85% of the companies that they invest in, and that the other 15% or 20% are going to have a substantial return for them to get the kind of return that Ryan's talking about. So the angel groups now are not what they used to be 20 years ago. They're very sophisticated and they have this same thought process.
So the bottom line is what that means is when you go in to raise money, when you have to be able to demonstrate that your company has the again, it's an investment opportunity, not a science project, that your company has the potential to be there, to be that winner. If all things go well, if you're able to hit the market, if your IP works, you know, all those kinds of stuff. But if you go in looking for money and say, hey, I think I can generate a 5% return over the next 10 years, that's going to be too low, because that's already, I mean, most investors assume that you will never do better than your projections. And so if you project a 5% return to the investor over the next 5 years, they'll say that's too low because I need to save my money for the companies where I have that chance for a much bigger return.
It has to be scalable.
Has to be.
So, 2, 3 companies, 5 companies, 10 companies come to you. Does it matter to Brian, to you, who has, and maybe to anybody, who has invested in them before you? Is it better if you're taking a company that Bob, Angels have invested in, you look at them and say, well, that's a really good group, they must have vetted them, and they've mentored them or whatever, does it matter at all, or do you?
Yeah, I think it helps. Certainly if it were somebody in St. Louis that we knew and we could just pick up the phone and talk to them about what the history's been like with the company before that. It helps if it's in our case, most of the companies we see have had some prior seed stage investing. So, that helps, but I think it doesn't, it's not a negative if we don't know them or if you didn't have prior venture funding. Helpful, but not a negative.
I guess the comment, we do look, if for some reason there was something screwed up with regards to the previous investment, if those were strange terms or the investor was behaving badly or that type of thing, that would be kind of a negative check with respect to raising capital from us.
Yeah. I had a client who had happened, it was in a space where they had 3 former CEOs of well-known CEOs in that space who actually had invested as angels in the company. And we touted that in all our private placement memorandums and so on as, hey, these people, we had 25 angels, including these people who you may know. And so I think that was helpful, and I think, but you have to be careful that those people actually, if they got a phone call from someone, would say, oh yeah, I believe in these guys. I know them, I've known them for a long time, that kind of stuff.
One more question, go ahead.
This should be a really easy one. I'm just curious, at the angel level and as well as at the VC level, what time of timelines, or is there kind of an average timeline that you guys are interested in for exiting?
Well, it's never, how do I put it? It's always longer than you expect. What we've learned in St. Louis is, with the Archangels, is the exits are much longer than we had anticipated. And so we've invested in over 80 companies, and we've had some exits, some modest exits. We've had a few that were pretty good. We have a few that look like they could be humongous, but we're going on, as Ryan said, 9 or 10 years. And that should be expected. But I think that some of the investors were too optimistic and expecting that they would have exits in 4 or 5 years. And so I think we have to be a little more realistic in our expectations. So I think the idea of that it's going to take 8, 9, 10 years is the way that angels need to think. Because it's the reality, especially in life science. If you're talking IT, that's a different story. Some of the exits we've had quickly have been IT-based companies. And so it depends on the industry that you're in. Okay.
Yeah, and that factors into our thinking too. So our fund, as Ryan mentioned, is a typical venture fund where we have a 10-year window for the fund. So we need to be ideally out of all investments at that point. So that's a factor that we think of as when we consider the investing in a company as, okay, when do we think this is going to take longer than normal? And will it be that 9, 10 years? And if so, that might really have us kind of step back. And if there's an opportunity earlier, then we might get more excited about it.
So just for clarification purposes, for you as an angel investor, if we were able to raise capital from the VC later, does that count as an exit? Do you guys make money on
No,
that? Or
no.
you just don't have
Because he is a venture capitalist, is not going to want to buy my stock he wants me in the deal with him to the end. No, so that's not an exit.
But there is an opportunity for growth funds to buy the early investors out.
Yes, that's right.
So, but that's a different thing. They'll buy the early investors, provide an exit because they want to grow the company and they want to take out the early investors.
Yeah, kind of the people who are writing a $50 or $100 million
$100 million
check or
check.
something might
Yeah.
allow
So on
to
that note, the $100 million check. We're going to wrap up this panel. Thank you very much.
Oh, I thought